Hello, everyone. I'm Gavin Roberts. I am the instructor of your Economics of Cryptocurrency class online this semester, and this is the first lecture video of that class. Just a little bit about myself. I'm an associate professor of economics at Weber State. I'm also the chair of the economics department. I think this will be a very interesting class for you. Regardless, some of you probably are very interested in cryptocurrencies already. Maybe some of you are not at all. But I think in either of those cases, also maybe some of you are like, oh, cryptocurrency is really cool, and some of you may be like cryptocurrency is really dumb, and that's okay too. Um, what I want you to get out of this class, what cryptocurrency definitely is a very interesting place to study and learn about economics and the economics of money and the economics of finance and the changing face of finance. Because even outside of the sort of popular crypto realm of Bitcoin and Ethereum and things like, I don't even remember what they're called anymore. The pictures that were worth tons of money that kind of have gone out the window now. Outside of that, there's a lot of changes happening in the digital financial world, and understanding the economics of cryptocurrency is a really good way for us to start understanding those changes and really maybe to be more innovative in our own lives because these things are changing now, changing quickly. If you keep up with the financial news at all, you know that already. And I encourage you to look at news about cryptocurrencies as we work through the semester. I will definitely show you some news about cryptocurrencies during the semester and a variety of things. Now, the purpose of this video is first, I'm just going to show you how this class is going to work as an online course. And then in the second half of video, I'm just going to give you a brief review of supply and demand and talk about some cryptocurrency issues related to supply and demand. But really, the purpose of that is just a brief review. Based on who's in this class and what their majors are, I'm pretty positive that you've all seen supply and demand before. Some of you are economics majors, and that might be a little annoying to you, but others are not economics majors. That real review is just we want those concepts ready to go for the future of the class. So let's jump into it by first just taking a look at the Canvas page. So the Canvas page is going to be relatively simple, and I'm trying to make a pattern so that you have easy expectations about how each week will work. So of course, this is week one right here. So I'm on the module on the home page, which is the modules page. So that's where you're really going to live in this course. Everything that you need should be accessible from the current week module for this course. So this is week one. I'd like you to check out the course overview. Um, and then I also have weekly overviews. This one's the course entire overview because this is the first week. And then each week you'll see a week overview. So week one overview, week two overview. Each one, of course, will have a lecture video. And then each week we'll have two types of assignments. One will be a quiz that's due on Friday evening, and the other one will be what's called a collab assignment, which is due on Sunday evening. I will talk more about those collab assignments in the second video because here I'm going to show you part of the lecture will be what's called Colab, and then you will basically edit what's called a Google Colab notebook in your assignment. Now, that's going to involve a little bit of coding, but the purpose of that is not to necessarily teach you coding, it's to give you some experience seeing code, making very minor changes to code to complete the assignments. But really, we want you to be comfortable in this world being able to look at things like Python code, using AI to help you understand Python code, maybe using AI to help you write some Python code. Some of you have probably already engaged in those things, but because of this increasing digital technological world, just having access to those things, that's partially the purpose. And on top of that, Colab notebooks are a really nice way to do a lot of stuff at once. Analyze data, look at some math, which we'll have to do in this class. Look at charts, look at different diagrams. So it's just a really powerful tool to do a lot of things in one place. I'll talk more about that again, as I mentioned next week. Then each week there will be a quiz. The quiz will be um, the questions I think are pretty difficult, but like you could probably just use AI to answer them. I really encourage you to make sure you understand quiz questions, regardless of how you decide to complete those quizzes. It would be considered cheating to use AI in the quizzes, but I don't have a good way to stop you from doing that because I'm not going to make you come to the testing centers every single week to do a quiz. I don't want to make you do really complicated software type stuff to take the quiz for proctoring. So really that's going to be it's incentive motivated. Why that is because if we take a look at assignments, we're going to have 20% of your grade will be those quizzes. Oh, and I'm glad I came here to remind myself of this. I also put an assignment with meet with instructor in January. All I want you to do is send me an email. We'll pick a time that we can meet. It can be in person or virtual. I always do this in my online classes to just form some type of human connection in online classes. I'm a human, you watching this are a human. It would be good for us to just chat, and then we'll be more comfortable. If you have questions, it'll be easier for you to come to me and things like that. It'll be a very casual meeting. You will get all of the points for doing the meeting and none of the points for not doing the meeting. So there will be more than 3 weeks, obviously. I've built out the first 3 weeks of the class. I will add as we go. I will try to make sure that the lecture videos are available to you when you wake up on Monday mornings. That's the deadline I've given to myself. I will let you know if something comes up that causes me not to be able to do that. I don't foresee any issues there. Now, here's your collab assignments. Those are going to be worth 25% of your grade. We don't have one of those this week, but moving forward, most weeks will have one. Now, getting back to the incentives to understand these questions, we're going to have a midterm exam and a final exam. Both of those do need to be in a Weber State Testing Center. We have the due dates here, so that's going to be the last time that this actually will not be open until 12 p.m. Why? Because the testing centers are not open till 12 p.m. So here I put 5 p.m. That one, you should think about it as like 5 p.m. or whatever the last moment you can show up on that day to get into the testing center and have time to take the tests. And I'll remind you guys of that as it comes forward. But really, those questions, those will be both multiple choice tests, and they will be very similar to the concepts in these multiple choice questions from the weekly quizzes. There will also be some stuff that we learn in other places, of course, but the core of that will be the types of questions from the weekly quizzes. So it's important for you to actually understand the answers to those questions because I won't put exactly the same questions. So memorizing the answers will also not be useful. But it is important for you to understand the concepts. And I've tried to write them. I also try to write the quizzes in a way that you actually learn some things while you're taking the quizzes. So one example of that, our book, which I emailed you about, um, Bitcoins and Blockchains. They use some language. Sometimes I use the same language of those as them, but sometimes there's many words for the same concept in economics. So sometimes I mix up the language, and that's by design because I need you and you need yourself to get used to those types of things if you're going to live in this complex digital technological world, because that's just a thing that occurs. And it's also helps you be more confident when you understand these different complicated issues, which involve a vocabulary, various vocabulary, and will also make you appear to be much more competent to people when you go out to the workforce. Because, again, these are growing industries, not necessarily just the popular sort of cryptocurrency things, but just in general. Let me show you the book real quick. So we have Bitcoins and blockchains. I'll just show you it's available in places other than Amazon, but I sent you guys a link to this just to make sure this is the book. You can get it at Amazon. Um, you can get hardcover for $9.99 if you're a hardcover user. Any of these, I don't care what format you use, just audio might be a little bit weird unless it also gives you a transcript that you can look at because it might be hard to just go back, but I am fine with any of format of the book. Whatever you can buy is fine. But this is what the book looks like. It's a pretty easy read, but there is some language in there you might be like, I don't know what this word means, and you should look it up at that moment or talk to me about it and any concepts in the book that he gets into. Because I think through his experience, sometimes you're like, wow, this is way too easy to understand, but then all of a sudden you'll be like, I don't understand that paragraph because he's using a lot of industry jargon, for example. And you want to kind of become the type of person that's willing to go learn about those things on your own because that's who employers are going to really want in their And you have tons of tools to do that, obviously, right now. And it's important as a student, in addition to just having more knowledge, understanding the tools that are available to you and using them, being proactive and things like that. So let's go back. I think I covered all the main bases about the organization of the course. Please don't hesitate to reach out to me if you have any questions about this, anything else related to the course, or the economics department for that matter. Because I mentioned and I think most of you are economics majors. If you're not, don't feel like I'm biased against you. Please reach out anytime, and I can help you managing your degrees too, because I think everybody's in the business school, maybe one or two students are not. So now let's go take a look at the supply, just a simple supply and demand review, because we'll want this stuff in our heads as we move forward in the class. And I'll put these slides in the Canvas page so you have access to them. What do I want to do? Play it from the start. So supply and demand review, crypto version. And it's not really that much of a crypto version, but I'm going to point to some things where this shows up in cryptocurrencies. So let's start by just looking at, I mean, the most popular famous Bitcoin or called Bitcoin, which oftentimes other cryptocurrencies are called Bitcoin, which is Bitcoins, which is very confusing. But the most popular, obviously, cryptocurrency, which I'm sure all of you have heard of, is Bitcoin. And this is its price history since about 2014. It started, I think, in 2009. I mean, less than pennies maybe when it started. And now, I mean, we see it's at 90,000, I think, when I checked this morning, and it went up above $100,000. So I mean, the market cap of Bitcoin is insane. Let's actually look at that really quick. Let's see what the current market cap. Where is the market cap? So right here, let's just look at it what it is right now. $1.821 trillion dollars. So what that means is if we take this price and multiply it by the number of Bitcoin in existence, then we get the total value of Bitcoin in existence, right? That's $1.82 trillion dollars. That's insane. Down here it was like, I mean, in 2009 when it's less than a penny and there's hardly any Bitcoin, it's like nothing. So the growth is massive in terms of value. From current slides. So I just wanted to see like this is obviously exponential growth over time, but also with massive volatility. And so there's a risk and a growth in Bitcoin in particular, and other cryptocurrencies look similar to this. I don't think quite as extreme as Bitcoin. Maybe some of these mean ones went crazy in the short run. But I thought just looking at this chart, how much growth there is in a relatively short amount of period of time in Bitcoin, I thought was a really salient thing to just think about right off the bat. And these are prices. So then supply and demand, we know gives us information or gives us predictions about prices. So now let's think about that. So just as a reminder, demand is the total quantity consumers are willing and able to buy of any good or service, including something like Bitcoin, at a given price. Or another way to say it is the maximum price consumers will pay to buy a given quantity. So we can say at a given price, they'll buy this much, or at a given quantity, they'll pay this much for that quantity. Both of those can be used to describe this curve. Quantity, price, price, quantity. And it's good to be a little bit flexible with that across the two different ors, because sometimes one is easier to work with than the other. Demand shifters, so things other than price change quantities that people are willing to buy. Or another way to say that using that switch is things other than quantity will change the willingness to pay. And so price is how much people are willing to pay, and things other than these two variables obviously matter. So let's think about some of those things. Well, income, if people have more money, there's many goods they will buy more of. So they might buy more vacations. They might buy more Bitcoin. I'm not really sure about that one. That would be an interesting thing for somebody to look into. Um, but they might buy less of stuff too. They might buy less ramen, for example. That's a popular. or a famous example of what's called an inferior good. When people become richer, they buy less ramen noodles on average in the data. Styles, tastes, and habits, those ones definitely play a role in the cryptocurrency world. But things like bell bottoms were popular in the 60s. Demand shifted out for bell bottom pants, shifted back, possibly back that way a little bit. So those obviously can change the quantity people want at a given price. But there is not an actual change in like they want more at the same price because something has become more popular. So that would be reflected by moving to the right. Or they're willing to pay more for that one pair of bell-bottom jeans because they're more popular. That would be movement in the vertical direction. Prices of substitutes matter. So if you love hot dogs and hamburgers and all of a sudden hamburgers price goes up by 500%, you might eat more hot dogs. So there's interactions between the prices of different goods if they're substitutes. Also, if they're complements. If the price of hot dog buns goes to $1 million and you only eat hot dogs with hot dog buns, that would mean they were perfect complements. Probably not exactly true in that case, but you would probably buy fewer hot dogs in that world, especially if hamburger buns didn't increase in price. Expectations of future prices. This obviously plays a massive role in our cryptocurrency world. A lot of people demand Bitcoin today because of their expectations of future prices. What do they expect the price of Bitcoin to be in the future? Higher. Now, the opposite probably happens too. Some people say, "Oh, there was a policy announcement about cryptocurrency. I think that's going to decrease the price in the future, so I'll sell. I'm less willing to buy today." I should avoid using the word sell because that's not the demand curve, that's the supply curve or that curve right there. So willingness, the total quantity producers are willing and able to sell at a given price, or the minimum price producers will accept to sell a given quantity. Now, this one's kind of interesting in cryptocurrencies because you may know, and we'll talk about this more as we get into the weeds, Bitcoin has essentially a fixed supply. Its supply increases at fixed rate and will eventually stop increasing. So that means the total supply of Bitcoin, in some sense, is perfectly inelastic. That would mean that this curve is totally vertical. However, we can't exactly say that because I own a little bit of Bitcoin. If Bitcoin price went up to $500 million tomorrow, I would sell it. So I'm a potential supplier. So you have to think about that because oftentimes in other economics classes, we just plant this idea of somebody's producing something. They'll produce more of it if there's higher prices, produce less of it. Well, if I'm just an owner of Bitcoin, I'm a potential supplier too. And there's some price that I would be willing to sell, most likely, most people that hold Bitcoin. So those are suppliers too. That type of reasoning also applies to other assets like stocks. If I own a stock, I'm a potential supplier of the stock. I'm also a potential demander. I might buy more of that stock. So supply shifters, things shift supply curves around just like they shift demand curves around for reasons other than price or quantity. So factor prices or costs. One interesting one here. Now, this doesn't really work for Bitcoin, but other cryptocurrencies are produced in similar ways. Basically, throwing computational power at an algorithm causes more cryptocurrency to be produced. And Bitcoin is a little bit different than that. I'm not going to go into the details of that right now, but we can think of it that way, basically. If it was less expensive to throw a lot of computational power out, we would expect higher supply, outward shift in the supply of cryptocurrency production because we can mine what's called mining cryptocurrencies more cheaply if a CPU basically is less expensive. So that's a very important factor price in the cryptocurrency world. Opportunity costs, of course, also matter in economics. Opportunity cost is what am I foregoing by taking this action? So if I take $100 and I buy Bitcoin with it, what else might I have done with the $100? Well, I might have put it in a savings account. And so I'm foregoing the savings interest rate. And so you might say like, well, that's great. Like that's a great choice because the Bitcoin appreciation is likely to be much higher than the savings rate in the long run. That's true, but the risk of holding Bitcoin is also much, much higher in the long run. And that's always a trade-off that investors are thinking about. What's the return? What is the risk of getting that return? And because of that relationship, risky assets tend to have higher returns, and less risky assets, like putting your money in a savings account, have lower returns. And so opportunity costs always matter in financial markets like cryptocurrency markets. Expectations of future prices again, if we think Bitcoin is going to crash in the future, I want to sell my Bitcoin today. And so that's a supply issue. I'm going to shift right my supply today if I think prices are going to be lower than they are today in the future. Number of sellers, of course, if everybody's trying to sell their Bitcoin or other cryptocurrency on the same day, that is an outward shift in supply. Natural events could be really interesting in cryptocurrency markets because we could have natural events impacting energy prices. Energy prices play a big role in cryptocurrency supply. So now that we have our two fundamental curves, demand and supply, in our fundamental economics model, supply and demand, we can discuss equilibrium. So markets clear is one way to say we reach equilibrium. Markets clear, there's no surpluses or shortages, is what that really means when demand and supply are equal. The point where supply and demand meet is called the market equilibrium. So that's right there. And we have an equilibrium quantity and we have an equilibrium price. Those are on both the supply and the demand curve. And now we can think about why do prices change? Well, that's because of shifts in supply and demand. So if all of a sudden everybody's like, oh, the new hottest cryptocurrency on the market, then you're going to have your crypto bros shifting out, the price is going to go up. Now, probably the price is going to come back when that becomes less popular again. Maybe it is going to even go way down there when people are like, that's the least cool crypto today. But this is fundamentally, even with all of that Bitcoin volatility, this is fundamentally how economists model what's going on here with prices. So, what explains then this massive increase? Well, I kind of alluded to the fact that the supply of Bitcoin is essentially fixed. It's basically a vertical curve that goes to the right slowly over time. Now, there are people like me who own a little bit of Bitcoin that might be able to sell it. So I'm a supplier too. That's what makes it not perfectly vertical because there's some price where I'll sell. That means that it's actually a little bit downward sloping. But given that supply is so stable, what explains these massive changes? Primarily shifts in demand, primarily things like expectations of future prices. That's probably the biggest one, but also opportunity costs. When interest rates go way up, this might crash. Now, interestingly, interest rates stayed pretty high, but this came up, but interest rates were going down for most of this time period. So interest rates play a huge role in this. Um, Also, things like political events play a major role. So people thinking about what's an opportunity, holding cash is an opportunity cost of Bitcoin. Well, what if I think there's going to be much higher inflation because the government is spending and printing a lot of money? Then I might be willing to hold more Bitcoin because holding dollars has become more costly. But again, the fundamental model we use to explain those prices is shifts in supply and demand. And those are all equilibrium prices under economic reasoning. What's happening in the background is demand and supply are shifting all over the place. So then, of course, supply can shift too for the reasons we mentioned. Here we had an outward, more demand leads to higher price, a shift along the supply curve. The quantity supplied is higher here, the price is higher here, the quantity demanded is higher here, but we're on a new demand curve. So demand shifted. Here, supply shifts, movement along the demand curve when supply shifts. Maybe something like CPU costs went down. So people are mining more cryptocurrencies. And then we'd expect a lower price from that higher supply. Now, finally, I just want to talk about some key shifters that I've already mentioned briefly, but here I've organized them a little bit more. Key shifters in the cryptocurrency markets. We're going to talk about all these different issues throughout the semester. So demand already mentioned a lot. Probably the biggest one with Bitcoin, at least for example, is expectations of future prices. Opportunity costs already mentioned, and then I explicitly mentioned interest rates, but other assets. That's if we're thinking about Bitcoin at least as an investment, which is not the only way to think about it, but if that's the way we're thinking about it, then other assets, and those other assets, one could just be earning the interest rate, buying a government bond or putting my money in a savings account. So that's an obvious example of one, but you could also just buy Google stock. You could buy stock in a company that is involved in cryptocurrencies instead of just buying cryptocurrencies directly. Those are all different types of opportunity costs that will impact demand. Price of substitutes and complements, so prices of different cryptocurrencies. If they're considered substitutes, and prices of different cryptocurrencies if they're considered complements. So Ethereum is a major, probably the number one competitor to Bitcoin. Many other cryptocurrencies live on Ethereum's blockchain. And it's okay if you don't know what those things mean yet. And it's okay if you do. We're going to go into the weeds on those things in this class. But they could be substitutes or complements. So, an opportunity costs, I mean, these are not necessarily all mutually exclusive. We could talk about a substitute in opportunity cost terms. So now supply CPU cost, so that's basically computational power, computer power, factor prices. So those are the things I need to produce something, are called factors. The prices of those obviously will impact my willingness and ability to supply the thing that I'm producing with them. Computational costs are probably the biggest one in cryptocurrency. Opportunity costs, because I could take my CPU, my computational power, I could mine cryptocurrency with it, but I could also do things like run AI algorithms with it, um, try to do other stuff with my computational power. So opportunity costs matter on the supply side as well. Um, Types of computer chips obviously will matter in a variety of different contexts too, because certain computer chips are made and it's like, well, these are really only good at mining cryptocurrencies and aren't good at other things. Well, that means the opportunity cost is lower of using it to mine crypto if it's not very good at anything else. So the number of sellers obviously is going to matter as well. If more people are in cryptocurrency markets, like me, I came in as a demander, but makes me a potential seller. To the extent more people own Bitcoin, there's more potential sellers in the market. And then natural events, again, as we already mentioned, energy prices can be impacted by natural events or things like wars. I mean, I'm making this video, I think, 2 days after the United States went into the country that has the largest crude oil reserves on the planet and took the dictator out of that country, basically. That is not necessarily a natural event, but probably will affect energy prices. I'm making this video on the weekend, so we're going to find out Monday morning, or we're going to start finding out probably Sunday night when markets start to open in Asia, what the impacts of that on energy markets and on cryptocurrency markets are. And I'll mention that for sure in my next video, just as a current event that will be interesting to think about this semester. Of course, in economics in general, but also even in this cryptocurrency world, because there will be connections there. Okay. So that was, I know, admittedly short, but really it was meant to be. Um, Keep these in mind, review them if you need to. Definitely ask me questions if you have any questions about what I just covered. Hopefully it's review-ish, but maybe it's been a long time since some of you have seen it, so I'm happy to chat about those things with you. Okay, so I will leave you there. Again, please don't hesitate to reach out if you have any questions. I encourage you to set up this meeting with me early, and I also encourage you to meet with me often. Don't just use the meeting that I'm requiring you to have with me. I am happy to meet with you many times throughout the semester. These are very interesting issues, I think, with cryptocurrencies and digital assets that we're going to be covering this semester. So I'm excited about it. And I look forward to meeting you. Bye bye.